Hey everyone, welcome back to the channel. If you're in real estate, whether you're buying, selling, or just watching the market, you need to understand one thing. Mortgage rates don't move randomly. They're deeply tied to the bond market, especially long-dated Treasury yields. And this past week, the bond market threw a curveball. Today, we're diving deep into the recent stock market wobble, the mysterious spike and drop in 30-year Treasury yields, and how all of it connects to your mortgage rate. We'll explore tariffs, Fed independence, and European politics, pension reform, and more. Buckle up. This is the full story beyond the numbers. Why does this matter to you? Because mortgage rates are one of the biggest factors in your monthly payment. A small change in rates can mean tens of thousands of dollars over the life of your loan. Understanding what drives those rates gives you an edge, whether you're locking in a loan, refinancing, or timing your next purchase. This isn't just about economics, it's about psychology, politics, global finance, and investor behavior. The bond market is like the nervous system of the financial world. When it twitches, everything else reacts, including your mortgage. So grab a coffee, settle in, and let's unpack the chaos. By the end of this video, you'll understand why Treasury yield matters and what's driving them and how to use that knowledge to make smarter real estate decisions. The 30-year Treasury yield briefly passed 5% this week. That's a psychological and financial milestone. It's the highest level in years, and it sent shockwaves through the stock market, bond market, and housing sector. But what caused it? That's a mystery. Unlike typical market moves, this one didn't make a clear trigger. There was no major economic report, no sudden policy change, or no geopolitical crisis. Instead, it seemed like a spontaneous sell-off in long-dated bonds. Investors dumped them, yields spiked, and then, just as quickly, they reversed course and bought them back. This kind of volatility is rare in the long end of the bond market. Long bonds are usually stable, predictable, and boring. They're favored by pension funds, insurance companies, and conservative investors. So when they swing wildly, it's a sign that something deeper is going on. Theories abounded. Some blamed a court ruling on Trump's tariffs. Others pointed to fears about the Federal Reserve's independence. Still, others cited government borrowing, European political instability, or seasoned investor behavior. But none of these explanations fully accounted for the timing, magnitude, or reversal of the move. So what does this mean for mortgage rates? It means uncertainty, and uncertainty means lenders are nervous. When lenders are nervous, they raise rates to protect themselves. So even if the bond market calms down, the ripple effect on mortgage pricing can linger for weeks. One of the first explanations floated for the bond sell-off was a federal court ruling that struck down President Trump's use of emergency powers to impose tariffs. It upheld this ruling could force the government to refund billions in tariff revenue, money that was already spent. This would worsen the federal deficit, which is already ballooning. Investors worried that a larger deficit means more borrowing, more bond issuance, and higher yields. That's because the government has to offer better returns to attract buyers for its debt. And when Treasury yields rise, mortgage rates tend to follow. But the tariff explanation has holes. If companies were getting refunded billions of dollars, you'd expect the stock market rally. Well, that didn't happen. If tariffs disappeared, inflation fears should ease, allowing the Fed to cut rates. Well, that didn't happen either. And if investors feared government finances, they'd sell dollars. Instead, the dollar rose. Still, the timing fits. The ruling came Friday, markets were closed Monday, and the sell-off peaked Tuesday. That sequence suggests that ruling may have spooked investors over the weekend, leading to a knee-jerk reaction when trading resumed. For mortgage borrowers, this is a reminder that legal and political developments can have outsized effects on interest rates, even if the connection isn't direct. The perception of risk can drive yields in your mortgage rate higher. Another theory was concern about the Federal Reserve's independence. If the Fed becomes politically compromised, it might keep rates artificially low to keep elected officials. That could stoke inflation over time, which is bad for long-term bonds. In theory, this should push up yields on long-dated treasuries, as investors demand compensation for future inflation. But the data didn't support this. The break-even inflation rate, the market's estimate of future inflation, was unchanged. It stayed at 2.34%, well within its recent range. That suggests investors weren't actually worried about inflation. They were reacting to something else. Maybe it was fear of erratic policy. Maybe it was a shift in portfolio strategy. Or maybe it was just a technical sell-off. But it wasn't inflation. Still, the stability matters. If the investors lose faith in the Fed's ability to manage inflation, they'll demand higher yields, and that would push mortgage rates up further, even if inflation itself stays low. So while the Fed independence didn't drive this week's move, it's a lurking risk. Real estate professionals should keep an eye on political pressure on the Fed. If it intensifies, mortgage rates could rise further, even without a change in economic fundamentals. Let's talk deficits. The US government is borrowing at record levels. The pandemic blew a hole in the budget and spending hasn't slowed. That means more Treasury bonds hitting the market and more competition for investor dollars. When supply rises, prices fall. And when bonds prices fall, yields rise. That's basic economics, but it's especially relevant for long-dated bonds, which are more sensitive to fiscal outlooks. If investors think the government is overspending, they'll demand higher yields to compensate for the risk. This week, the 30-year inflation-linked Treasury yields rose slightly. That suggests some concern about real returns. But the 10-year inflation-linked Treasury, more relevant to mortgages, actually fell. That's a mixed signal. Still, the trend is clear. As debt rises, so does the pressure on yields, and the pressure flows into mortgage rates. Lenders have to compete with government bonds for investor capital. If treasuries offer better returns, mortgage-backed securities have to follow suit. For homebuyers, this means timing matters. If you see yields rising due to fiscal concerns, it might be smart to lock in your rate before mortgage lenders adjust their pricing. Across the Atlantic, France is facing a political crisis. The minority government can't pass a budget. The prime minister might be ousted. Bond yields are rising and investors are nervous. Normally, when European countries wobble, investors flee to German bonds, but that didn't happen this time either, which is very unusual. It suggests broader uncertainty. Maybe investors aren't sure where to hide. So why does this matter for U.S. mortgage rates? Because global bond markets are interconnected. If European investors pull out of U.S. Treasury, yields rise. And when yields rise, mortgage rates follow. So the French 10-year bond yields recently hit their highest premium over German bonds since 2012. That's a major red flag. It means investors see real risk in French debt, and that risk can spill over into other markets, including the United States. So even if you're buying a home in Maryland, French politics can affect your mortgage rate. It's a global game, and every move matters. Let's head to the UK. British gilts, government bonds, have been under pressure since Liz Truss's brief tenure. Pension funds aren't buying like they used to, and with few other buyers, long-dated gilts are vulnerable. This week's sell-off in 30-year gilts were notable. There were no clear trigger other than the announcement of a budget date, but investors reacted strongly. That suggests deep unease about the UK's fiscal path. So again, why should we care? Because the same dynamics apply to the US Treasuries. If pension funds here or abroad reduce demand, yields will rise, and higher yields mean higher mortgage rates. The UK's experience is a warning. When institutional demand dries up, bond markets can move fast, and mortgage rates can spike before you even know what's happening. So keep an eye on pension fund behavior. If they shift away from long bonds, it could signal trouble for mortgage affordability. Now, let's go run into the Netherlands. Dutch pension reform might sound like a niche topic, but it's actually one of the most significant structural shifts in European finance in years. The Dutch pension funds hold about 80% of all pension assets in the Eurozone. That's a massive concentration of capital, and it's also being reallocated. Historically, the Dutch pensions relied heavily on long-dated derivatives to guarantee future income. These instruments are tied to long-term interest rates, and their demand helps support the market for long-dated government bonds. But now, the Dutch are transitioning from a defined benefit plans to defined contribution plans. That means future payoffs depend more on investment performance than on guaranteed returns. As a result, Dutch pension funds are moving away from the derivatives and towards conventional assets like stocks and shorter duration bonds. This shift reduces demand for long-dated treasuries and similar instruments. Less demand means lower prices and higher demands and higher yields. And again, higher yields on long bonds translate into higher mortgage rates, even in the United States. The reform is gradual, but its effects are cumulative. Over the next few years, we could see a steady erosion of support for long-dated bonds that would put upward pressure on yields even if inflation stays low and the economy remains stable. It's a slow-moving force, but one that real estate professionals should watch very closely. For mortgage borrowers, this means the long-term outlook for rates could be less favorable, even if short-term volatility settles structural challenges like Dutch pension reform could keep mortgage rates elevated for years to come. So let's talk about September. Some analysis chalked up to the bond market's behavior to seasonal patterns. Investors returned from summer vacations, reassessed their portfolios, and decided to sell long-dated bonds. That's a tidy explanation, but it doesn't hold up under scrutiny. If seasonality were the main driver, we'd expect a consistent pattern year after year. But this year's sell-off was unusually sharp, and the rebound was just as dramatic. That suggests something more than just a calendar effect. It points to deeper uncertainty and shifting investor sentiment. Still, seasonality does play a role in market psychology. September is often a time of transition. Kids go back to school, Congress reconvenes, and financial institutions prepare for year-end positioning. That can lend to increased trading volume and sharper price movements. For mortgage rates, this means volatility can strike at any time, even without a clear reason. Borrowers should be prepared for sudden changes and consider locking in rates when conditions are favorable. Waiting for perfect timing can be very risky in a market driven by sentiment. Now let's bring it all back to the mortgage market. The 10-year Treasury yield is the most important benchmark for mortgage rates. That's because most homeowners either refinance or sell within 10 years, making the 10-year bond a natural proxy for mortgage duration. When the 10-year yield rises, mortgage rates rise. When it falls, mortgage rates fall. It's not a perfect correlation, but it's close enough that lenders use it to set pricing. This week, the 10-year yield bounced around, reflecting the broader uncertainty in the bond market. And so for borrowers, this means that timing is everything, as mentioned earlier. A quarter-point change in your mortgage rate can mean thousands of dollars over the life of your loan. If you're shopping for a home or considering a refinance, watch the 10-year yield like a hawk. Also, consider the spread between the 10-year yield and mortgage rates. That spread reflects lender risk, investor appetite for mortgage-backed securities, and broader market conditions. If the spread widens, mortgage rates can rise even if Treasury yields stay flat. Finally, remember that mortgage rates are influenced by more than just bonds. Credit scores, loan types, property location, and lender competition all play a role as well. But the bond market sets the tone, and right now, that tone is volatile. So what does this all mean for you? The buyer, the seller, the investor, the homeowner. It means that the mortgage market is more complex than ever. Rates are no longer just about inflation or Fed policy. They are shaped by global politics, pension reforms, investor psychology, and structural shifts in capital markets. This week's bond market chaos was a wake-up call. It showed how fragile long-dated bonds can be and how quickly mortgage rates can react. Even without a clear trigger, yields spiked in reverse, leaving borrowers and lenders scrambling. As a real estate professional, you need to stay informed. Watch the 10-year yield, follow Treasury auctions, and pay attention to global news. And most importantly, educate your clients. Help them understand why rates move and how to protect themselves. If you're a buyer, consider locking in your rate early. If you are refinancing, don't wait for perfect timing. But if you're an investor, factor rate volatility in your cash flow models. And if you're a seller, understand how rates could affect buyer affordability and market demand. Thanks for sticking with me through this deep dive. If you found this helpful, hit that like button, subscribe for more real estate insights, and drop a comment below. What do you think is driving mortgage rates right now? Let's talk about it. Until next time.